All right, so today we will talk more around blockchains, introduction and history. We'll talk about Bitcoin, then we'll have a break, then we talk about Ethereum and blockchain use cases. We'll stay fairly high level. We'll dive into proof of work at a high level and probably use the whiteboard to explain that to you as well a little bit. Don't worry well, try to understand it at a high level. Don't worry about kind of the deep technical underpinnings. In the next few lessons, we will cover the cryptographic foundations, and then we'll go back to kind of proof of work and kind of build out conceptually blockchain from scratch. All right. So in terms of digital payments, they have actually been around for quite some time. So in digital, not necessarily digital payments, but digital processing of payments or transaction data. So in 1955, Bank of America unveils the ARMA computer for check processing, and that reduces the processing time by 80%. 73, Visa first digitizes credit cards, also reducing processing time. So generally speaking, just more efficient. In 1990, the World Wide Web got invented. 1994, Pizza Hut started accepting order payments online. And then we started to see the first online banks. OP Financial Group was the first one. And then in 1997, Coca-Cola starts offering the first mobile payments using text. And today, digital payments or electronic payments are all over the place, making up 2/3 of all non-cash payments. And I'm sure you all use a plethora of apps to pay, and even not just pay in the store, but also like transfer money amongst your friends and family. So Bitcoin was invented or conceptualized in 2008 and then implemented in 2009. But even the years prior were developments that really contributed to the Bitcoin white paper, indirectly and directly. So the first kind of movement was the cypherpunks movement. These were activists, or are activists, there's still certainly cypherpunks around, that advocate for social and political change using cryptography. I'm not sure whether you remember the kind of the crypto wars around PGP, where the government tried to restrict the utilization of strong cryptography. In 1980s, Eric Hughes, in 1993, Eric Hughes published a manifesto that really advocated for privacy and privacy in payments. And it's kind of rooted in the fact that, freedom of speech, leads to discussion of ideas, exchange of ideas, and if there is no privacy, that could constrain those sort of discussions and formation of ideas, and that also transfers to payments as well. And so he was really advocating to use cryptography to generate kind of a payment system that remains private. They proposed ideas of digital cash, and later those members of the cypherpunk group became part of the kind of the Bitcoin, or contributed to the Bitcoin's creation. Then a few years later, there were a variety of efforts to actually generate digital cash. There was DigiCash, there was B-Money, and those were all digital cash concepts that relied on cryptography, but they all and therefore did implement kind of the privacy promises that the cypherpunks were looking for, but they all that came up late. Sorry about that. And then there were some other developments that happened independent of digital payments. So Hal Finley worked on something called Hashcash in 1997, which was an anti-spam technology, where essentially in order to send an email, you had to compute, solve a cryptographic puzzle. And therefore, there is some expense associated with sending an email. But for you, as sending a couple of dozen emails a day, it would be not noticeable. But for the spammers that send millions of emails a day, it would have really caused them to not send those volumes. And that then later was kind of incorporated into a reusable proof of work algorithm. And then BitGold was actually proposed by Nick Szabo in 2004. And that was really a paper that preceded Bitcoin, but is extremely similar. So it had all kind of the essential elements like proof of work, decentralization, but it was never implemented. Which contrasts to Bitcoin, which was proposed in 2008 and then implemented in 2009. So one thing that that Bitcoin is trying to solve is the Byzantine's generals problem. And so this is a game theoretic problem, which describes the difficulty decentralized parties have in arriving at consensus without relying on a trusted central party. In a network where no members can verify the identity of other members, how can members collectively agree on a certain truth? And so kind of the example here is there's a bunch of generals that besiege Byzantium. They have surrounded the city, but they must collectively decide when to attack. If all generals attack at the same time, they will win. But if they attack at different times, they will lose. And the generals have no secure communication channel with one another because any messages they send or receive may have been intercepted or deceptively sent by one of the defenders. How can the generals organize an attack at the same time? Any thoughts on how they could do that? I'm sorry?
Paxos.
I don't know what that means.
The algorithms. Yeah, algorithms class. This is the basic problem that leads you to Paxos first, or then multi-Paxos as an algorithm to solve the problem.
Oh, can you tell us more about it?
Paxos explaining is really crazy. I think Raft is the easier one to explain, which is essentially like how do you establish consensus. And you basically need less than 50% to be bad actors.
Yeah.
For it to work.
That's right.
Is the constraint on it. I think that's true for Paxos as well. Like if you, in either case, if you get over 50% bad actors, it's tips over.
And that's the same in Bitcoin. Oleg.
Paxos relies on sequence numbers.
So then in 2008, October 31st, 2008, paper was authored by Satoshi Nakamoto, and I talked about this last time. This is really a synonym for somebody or a group of people, titled Bitcoin, a peer-to-peer electronic cash system. Satoshi did reference Hashcash and B-Money as kind of a preceding a solution to digital payments. What the Bitcoin paper, and I encourage you all to read it. It's actually pretty short and pretty concise. What the white paper proposed was a digital cash solution with the following properties. First of all, peer-to-peer payments with no financial institutions involved, so completely decentralized. Second, a way to solve the double spending in a peer-to-peer network. And I will talk about double spending in a couple of slides. A chain of transactions or blocks that are secured with proof of work. And again, I will talk how that actually looks like in a couple of slides. And then it also introduced incentives to secure the network. So essentially the mining aspect that also solves how Bitcoin are created. Like Bitcoin essentially come from the mining activity. Now, what the blockchain of Bitcoin essentially is, it is a state machine where you have an existing state and now a transaction comes in and a new state is generated or an error, and all kind of the intermediate kind of state changes are rolled back. Bitcoin right now is really, in terms of the use cases, is really just a transfer of value and payments and store of value. While there is kind of smart contract functionality that can be implemented on Bitcoin that expands its functionality to some of the use cases, again, we'll talk about a bit later. Really, Ethereum is the blockchain that expands the use cases, and Bitcoin is really focused on just transfer of value, payments, and store of value. Now, what is it? So Bitcoin is a distributed, secure, immutable ledger where participants are inherently not trusted. And what is a ledger? A ledger is essentially just a list, essentially, of transactions where there's a sender and a recipient and an amount. So in this example that I have here, we have John that somehow obtained 1 Bitcoin. We'll talk about how John did that in a second. And then John sends to Christian 0.1 Bitcoin, and John sends Danny a quarter Bitcoin. And that's what you would see on the blockchain. Now, if you then look at all the entire ledger from essentially the start, the Genesis block, to the block now, then essentially what you're able to do is derive the balances of each account. So in the example here, John sent 0.35 Bitcoin to Christian and Danny, so now, and had 1 Bitcoin before, and so now John has 0.65 Bitcoin, Christian has 0.1, Danny 0.25. So there's really no concept of balances on the blockchain, on Bitcoin. It is really looking at all the transactions from the beginning of time to kind of subtract and add Bitcoin to a particular account, and that gives you the balances. And why is it called blockchain? Is because the ledger here, these transactions are contained each in a block that are linked with each other through kind of hashing mechanisms, and I'll show how that looks like. Blockchain properties. First of all, they're immutable, meaning if you look at the blocks that I showed here, so think of these transactions being in each of one of these blocks, right? The block cannot be modified. So it really ensures that transactions are never deleted, modified, or otherwise tampered with. And kind of the way that is secured is through hashing, which we'll cover in one of the future slides, and provides censorship, resistance, and transparency, because again, it cannot be modified, so transactions will be always recorded. Now, if you think about what the cypherpunks called for is privacy in digital payment systems. Now, in Bitcoin, I kind of replaced addresses with names here, right? Usually it's just addresses, which is kind of a cryptographic hash of something. So you don't necessarily know who is sending who Bitcoin, but you are able to see every single transaction. It's all public, right? So if I send Oleg Bitcoin, and then Oleg later publishes his Bitcoin address on Twitter, right? Then you can determine that I interacted with Oleg, or at least the address that I'm associated with interacted with Oleg. I'm sorry? Blockchains in general are not anonymous. They're pseudo-anonymous, meaning that you see all the transactions, but you don't necessarily know who's behind the transactions. But there are several companies that specialize in kind of tracing the money and de-anonymizing Bitcoin addresses or addresses on blockchains in general. Oleg. These are also verifiable. That means that the transaction must follow certain rules. And in Bitcoin, a rule is I can only send one Bitcoin if I have a Bitcoin, right? Like if I don't have Bitcoin and I send Duke a Bitcoin, then basically says that's not a valid transaction because I didn't have enough.
So like a node that's operating in like the miner role is, in addition to doing proof of work to try to mint a block, is also saying, cool, you sent me this transaction, is this valid? If not valid, reject, discard, whatever.
That's right.
And don't include it in my ledger that I'm trying to commit.
That's right. And then when you create a block with all the transactions and now the new block is created, it gets distributed in the network, and then all the other nodes will basically verify it, right? And verify it means, is the block hash valid? Is the proof of work valid? Are the transactions valid? And if it's not valid, then that's not a valid block and gets rejected. And then lastly, it's decentralized. So there is no single point of failure. So every well, there's several roles in the network, but there's nodes that just kind of exchange blocks and transactions on the network, and then there are special nodes called miners that create blocks, but there is no central entity. And you know that makes sure that there is you know no single point of failure. Now, one thing that I would also mention, there's the network infrastructure, so meaning the nodes and the miners that kind of make this decentralized. But you also have to think a little bit about how the network is governed. So let's assume, and that if there's a book out there called Blockchain Wars, where basically the Bitcoin protocol, they propose to change the block size. And there was part of the community that says, no way, we're not going to change the block size. And the other part of the community said, hey, we want to change the block size. And that's great because it's all communities and they're able to then kind of shepherd the project forward. And if they don't agree, then they may fork the chain. But my point is that there is no central entity. There is no Bitcoin company that decides this is the rules of Bitcoin, and therefore it cannot be just changed. A change in blockchain involves really the broader community. There's the developers, there's the users, there's the protocols, and then there's also the node operators. And so, for instance, if you look at Ethereum, what happened a few weeks ago on the 15th of September, it moved from proof of stake to proof of work. Proof of work to proof of stake. Thanks. You know, you needed to have the validators to run validator nodes for proof of stake. Otherwise, that wouldn't have worked, right? All right. So this is the money slide. So this is really how the blocks and the blockchain is created. So bear with me. So assume we have kind of a set of blocks, block 1, 2, 3, and each block contains a set of transactions as well as a block hash. So block 1 has hash X, Y, and Z. Block 2 has hash ABC, but it also contains the previous hash of block 1, X, Y, Z, and then again, a set of transactions. And then block 3, same thing, a new hash, a previous hash of block 2, and a bunch of transactions, right? And basically, the previous hash is the link between the blocks. What happens on a blockchain network, you have nodes that essentially exchange that information on the network. So everybody kind of has the same state, right? Everybody has the same blocks locally stored. Then there is these special nodes called miners that essentially are the parties responsible to create new blocks on the blockchain. And how do they earn that right? They will solve a cryptographic puzzle. And the cryptographic puzzle that they're solving is the SHA-256 hash. The SHA-256 hash is a hashing function that basically takes some input and converts it into a hash, a unique hash, which is basically just a set of random bytes. And you're not able to go from the hash back to the input. So that's kind of a hashing function. And so what the miners need to do is they need to take the hash of the previous block. So let's assume this is the current block. So they take the block of the hash of the previous block, which is basically D, 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 and then they add a nonce, which is essentially a random number, and then they hash that. And so let's assume the hash is this. The rules of the Bitcoin protocol state that whoever creates a hash with the previous block hash and some nonce that starts with
Any number of zeros.
four, did I have 4 or 5 zeros?
5.
Then I win the right to create a block. And so the way a miner does that is they try out.
They find out the nonce.
That's right. They have to find out the nonce.
And they do that through brute force.
Brute force. They guess. So basically, they calculate the SHA-256 plus 0. Doesn't have a 0. 1, 2, 3, and they do it like a gazillion times in order to find a hash that starts with 5 zeros. Now this number, this 5, is variable. So if there's a lot of hashing power on the network, then the difficulty increases. So it can go from 5 zeros to 7 zeros, right? And then it will take longer to find the hash. This difficulty is determined based on the block creation time. So let's assume there is again, a gazillion miners out there, and they have a lot of computing power, and they are able to create blocks every 5 seconds. Well, that is too fast for the Bitcoin protocol. And so what the Bitcoin protocol then does, it increases difficulty for those miners to basically say, hey, you have to guess more in order to generate the hash that counts. So what that then effectively does, it slows down the block creation. Oleg.
Besides hash that over.
It's encoded in the Bitcoin protocol. So there is in the code, it says you take the previous hash plus a nonce, and if it starts with X zeros, you solved the cryptographic puzzle we asked you to solve, and you get the right to create a block.
There's lots of valid hashes.
So there's lots of valid hashes.
And it's not, so it isn't that Bitcoin requires 5, because I was trying to remember this. So the difficulty of Bitcoin is increasing over time is the way that the protocols define.
No, the difficulty is adjusting based on the hashing power of the network. So if there's a lot of miners.
Oh, it's because there's a lot of miners. So because like today it's, I don't know if that's today. In 2017, it was 18 zeros.
Okay, good. Yeah, I don't know. This is just an example. I don't know how many zeros you have to generate.
Competing with everyone.
Yes, you're competing with everyone. That is right.
So if there was only one computer, you'd be like, cool, 1 0.
That's right.
Which doesn't take long. You can get there quick. But if you have everyone competing, then it goes increasingly more zeros.
So the numbers, sorry, so the number of zeros, they are like adjusted automatically by the network, right?
That's right. It's adjusted by the hashing power. So if basically the block creation is too fast, then it will
Add more zeros.
say, yeah, it adds more zeros to kind of get it into a range. On Ethereum, the range, I don't know what the Bitcoin block time is, but on Ethereum, it's every 15 seconds.
I think Bitcoin started at 10 minutes.
10 minutes,
They
okay.
Adjusted.
Okay.
Who the heck is adjusting this? What if one node operating is using 3 zeros, another one is using?
It's another thing that's negotiated through consensus in the protocol.
It is.
Wait and never just wait until it's done. And what if you have, unless you have strict guarantees that everyone constantly agrees instead of you get a consensus like everyone.
You don't have to have a constant guarantee.
Yes.
Like, let's say that you're in a situation where like consensus isn't fully reached and you have some split brain going on. The block will basically be rejected by a set of nodes, but be accepted by a set of nodes. And in the end, if it's accepted by more than 51% of the nodes, that will eventually propagate and win.
So it's not necessarily consensus. It's encoded in the Bitcoin protocol.
So you're always going to have some number of nodes that are using a different number of zeros, and those will just get approved.
You may not have a different number of zeros because that honestly doesn't change that often.
So,
But you'll have.
at the exact point that it changes, you'll definitely get some.
Yes.
So basically, if you intentionally try to run a different Bitcoin source code, then you probably going to get like a different number of zeros, and then probably you will get like a new block that is going to be rejected by the others. Yeah, so if you can enforce other miners to use your source code, like more than 50%, then yeah, then there will be like a hard fork, something like that.
Even if you have everyone using the same source code, this can still happen just because of network problems. There's nodes all over the world.
But similar to any of the other distributed algorithms, it's eventual consistency, not immediate consistency. So you're looking for eventual consistency that is still immutable, that is still verifiable. So you're not guaranteed like completion of the transaction, and that's a huge difference from some other financial transaction systems like Swift. Swift is an asymmetric commit, so you actually know on both sides in the Swift transaction that it's done. There are other older forms that don't have that, so it's not uncommon for a financial system to not have a immediately consistent view of a transaction.
But to your point, if I'm a miner and the overall protocol says I need to generate a block of 5 zeros, and there's a set of nodes that say, oh no, it's 3 zeros. The majority of the nodes in the chain will reject my block because it is not a valid block according to the rules encoded in the underlying software.
I'm just making the point that this doesn't have to be due to bad behavior or negligence. The chain, not knowing that it's not supposed to be 5 zeros anymore, may simply not have propagated to you before you get a new block.
That's true. And then you kind of get screwed. Then you generate a block that has the incorrect number of zeros, and then it basically does not become part of the chain.
There's also the risk that you actually guess the same random number as someone else.
And
whoever gets 51% first gets the Bitcoin.
Yeah.
So I mean, it really is like being in mining is entirely law of large numbers. Like you're playing averages.
Location.
Yeah.
The more centralized you are, the better your property.
I mean, you could say if you are better positioned relative to all other nodes than another node, yes. But even that is probably difficult to answer for. Although Bitcoin is heavily weighted to like America, China, and not China anymore, Germany. There's like 4 or 5 countries that have a much higher node count than the rest of the world. So probably want to be there.
Europe is more centralized, has better internet, so yeah, I would imagine mining would perform very well. I think China was doing both because of the very cold. And then again,
Yeah, electricity is too expensive.
Now, one more thing. If you solve the cryptographic puzzle, what will happen is now you get the right to make a block. Now, Oleg, to your point in terms of who determines the order of transactions in that block, it is the miner who solved the cryptographic puzzle.
what's the timestamp server?
Timestamp server. I am not sure that
I don't
know.
I think there is a
You guys want to
timestamp
look it up, it's there.
There is a block timestamp, but I'm not sure it depends on
The order of transactions prevents the classic double spending.
I will talk about double spending here in a second. I think where the timestamp server comes in is determining the difficulty, because in order to determine whether the blockchain is too fast or not. But basically, in terms of the transaction, so that the miner that solved the cryptographic puzzle then reaches into the mempool, which is essentially a queue of all unmined transactions, and then picks out the ones it wants to include in the block. And the miner is able to determine the order of the transactions with some constraints, because in Ethereum, basically, you have an account nonce that when you sign a transaction and then you sign another transaction, there's a nonce, like basically an ordered number that tells you which one came first. But if you sign a transaction, Duke signs a transaction, Maria signs a transaction, a miner can basically say, hey, I'm going to include Oleg's ones, but not Duke's. So when they solve it, they get Bitcoin. And today, they receive 6.25 Bitcoin when they solve the cryptographic puzzle, which is about 125K. Well, probably less now, but Mark.
It looks like a verification step. So like after you solve for that part of the puzzle, you got this to then go back and trace like the past 3 blocks or something. You have to do like more work to make sure that it's not the same block, but then you can prove that.
It should say that it's not when you solve it, it's when your block is accepted. So it's because it's like you could solve it. Like I could guess a number right now. I'd be like, oh, that could be a block. That doesn't matter. It's when it's accepted by the network, and they may delay payment to say that like once you're blocked, because there's a new block every 10 minutes. So it's very reasonable to say like, hey, before you get your 6.25 BTC, we're going to wait for 3 more blocks to get generated, and for you to be a part of the consensus fork, of a depth of at least 3. Because if you're at a depth of 3, at that point, the probability that a fork comes and like supersedes your transaction goes away. Additionally, your 6.25 BTC is only valid assuming that you are on the consensus fork. Because if eventually another consensus fork went out, like Europe and America weren't talking to each other on the internet for 6 months, like whichever one of those consensus forks wins out, like your transaction disappears because it wasn't part of the correct transaction point.
So we talked a lot about kind of the number of blocks, depth, and fork. So let's briefly explain what that is. So we have a blockchain. And so let's assume at this point, somebody solves the cryptographic puzzle and creates a block. And let's just assume for the example sake, there's somebody else who also solves the block, the cryptographic puzzle as well. And they are able to create a block here, right? So now you actually have two blockchains because here's a bunch of transactions and here are a bunch of transactions. Which one is the valid one? You don't know that. Basically, what needs to happen is you need to wait for essentially the network and the miners to decide. And the way they decide is basically they say, well, I'm going to continue to solve cryptographic puzzles on this one, right? Instead of this one. And the chain that is the valid chain is the longest chain that exists.
What if you just defer your decision to verify either of those chains until you find a block on one of them? And then once you know, you can continue the chain, you have an incentive to then verify the one that
Then you've defined a different protocol. So this is a choice of Bitcoin. So Bitcoin made the decision to say, instead of going through other kinds of verification and other kinds of validation, we're going to let forks live. And the network will pick up, not the network actually, a node will pick up whatever it thinks is the next block, and it will build off of that block. And given some amount of time, more nodes will have created, something that is in consensus, meaning just more than 50%, and you'll end up with one that's getting built on faster because everybody's trying to build off of it. So probabilistically, if you have 60% of the compute power trying to solve for one, it's going to get solved a little bit quicker. The other one's going to get solved a little bit slower. And eventually that length of chain will become apparent and they will trim the competing. And that's not perfect because.
I understand. My point was that the node operator has to choose which chain they prefer to build on it. If they should defer their decision until they're able to build on it.
Let me address that. Basically, you have to think about that these miners have a huge data center that consumes electricity. They could wait, but they're not going to make money if they wait, right? And
they're
so
probably actually computing on many branches at once. And whichever one they get the most blocks for, they'll confirm.
I think there is probably strategies that they employ like that, where they're like, oh, which one should I go for? Maybe they do try both, right?
Both, yeah.
Right?
I mean, right now it's 32 trillion attempts.
Plus you hit your bets, so when one of the blocks gets pruned, you don't lose everything that you computed. If you're calculating for all blocks at once, you'll always contribute to the next block, at least locally.
I mean, this sort of situation is fairly rare, right? Usually there is a chain. But to your point earlier, let's assume you solve the cryptographic puzzle here and you have 6.25 Bitcoin. You're going, yeah, I got $100,000. But if the chain doesn't grow here, you have nothing because it will contain a transaction that says miner gets 625 BTC.
It's probably like the last transaction of the block or something like
Yeah,
that.
but if this
It doesn't
branch
exist.
dies, it's not the valid blockchain, right?
Which actually creates an economic incentive for you to not check all blocks, but to always take the block that has the most transactions or the block that has the most evidence of propagation. Because it forces you back into that because otherwise you're spending energy to go try to build a chain. And unless you think you have enough energy to supersede the rest of the nodes, in which case you should do it because you can have all Bitcoin in the world.
So how exactly do miners choose the next block that they want? Does that process happen automatically, or they need to
They receive a new block. So you receive block with hash D.
Yeah.
And you start looking for a successor block by solving for the hash D with a nonce that is sufficiently complex given where the difficulty level is right now.
That's right. And which one do you mine on? This one or that one? You take the longest one, because that's the valid chain.
But when the fork happens, so basically,
So you're thinking about,
yeah,
like right here?
yeah, like,
I mean, that is to Oleg's point, like, maybe they split their hashing power and try both, or maybe they
Well,
just
but
do
you have
one.
to think about how that happens. The way that happens is that you actually have a disconnect in your network of some kind. So you have like a severe latency, or like a cable underneath the Atlantic got cut, and you know, this side's off doing something, and this side's off doing something. Once that's reconnected, the longer side's gonna win. But even like the amount of time that you'll stay in that state is at most 10 minutes.
Or you get really lucky, because it's on average 10 minutes to find a new block. You could just find it right away, and you have the timestamp when the last block was generated.
Sure.
Yeah, and then basically what will happen, probably the difficulty goes up. So then the next block will be longer, but you're right, it could be that you're lucky and a new block gets generated. Question I have for the class: how does this prevent double spending? Mark?
You split, like, so say, like, okay, that's the main block, that person would draw that did it off, so like, just get like a transaction that I'm gonna send Bitcoin to Oleg, and I'm gonna send Bitcoin to Choke, and then keeps going, so you have like a kind of like valid money, we got to spend money, so I actually sent my money with Bitcoin to Oleg, and then I didn't really send Bitcoin over to Tuck, but I just said I did, and so I could spend it twice in one place and get whatever good I want, drugs, whatever. Then I need someone else to, I have two valid, there's one real one that actually spent money, that's maybe legitimate, maybe I paid rent with it or something, and the invalid one. Then in order for my invalid chain to keep going, it needs to be verified on the network like 3 times, like Paul was saying earlier. So that way I essentially need, like, I made a new fork, and I have to beat up the network 3 times in a row, solving that hash, make sure that my transaction gets pushed to the front of the chain. And the only way to do that would be that, like, I would need 50% of the network, because I have to have, like, probabilistically be able to beat them the entire time, like 3 times in a row, back to back to back. And
Yes.
it's me versus the world, it's like that.
Great explanation. So you have 1 Bitcoin at this block, right? And now you send Oleg 1 Bitcoin. Now you could also send a transaction in a different block. So first of all, let me just, okay, Mark sends all 1 Bitcoin. That's not valid, right? Because you don't have 1 Bitcoin. You don't have 2 Bitcoin, you only have 1, right? So this doesn't work. The only way you could do it is if this happens. At this point in time, because there's 2 valid chains, right? This chain is 5 blocks long, and this chain is also 5 blocks long. And so both of these valid blocks were created because here you have 1 Bitcoin. On this chain, you spend it, sending it to Oleg, and you send it to Colin, right? And so this does double spending, but it gets prevented by the fact that one of these chains grows and one of them will die. And so if I'm in a coffee shop, right, and spend it that way, you have to wait until X number of confirmations before you can believe that the Bitcoin that you just sent me was actually sent to me. At this point in time, right here, it is still too uncertain, right? Because there's 2 valid chains, right? One of them could grow, one of them could not. And so you usually wait several block confirmations before you say, this transaction right here is the one that is part of the official Bitcoin chain. Does that make sense? So, and that's why you see when you, like, for instance, transfer Bitcoin into, let's say, your Coinbase account, which is a centralized exchange, you see it on Block Explorer as, hey, it's been mined, but they don't allow you to spend it after some block confirmations. So you have to wait. And so that means Bitcoin is not the fastest.
Just pull up the paper on there. I would just scroll through your specific sections.
Oh, you have a paper that you want to show.
Yeah, I would go through the Bitcoin paper really fast and then jump to the proof of stake paper.
Okay.
So they have their own pros and cons list at the end. But I found that the best distinction categorically to draw between proof of work and proof of stake is that you have a lot more dependence in Ethereum's proof of stake on consensus, and Bitcoin using proof of work has a lot more emphasis on computational output. That essentially is the authority on the chain, whereas in Ethereum, the authority is a lot more distributed because you only need to stake 32, and you can do pooling. So even if you don't have 32 Ethereum coins, you can still stake collectively in a pool of individuals where collectively you can stake all your Ethereum together. So the barrier to entry is a lot lower. Like in order to be participatory or relevant in the or to be making any money from proof of work schemes, you really need cutting edge. You need like a server farm. You can't just do it on your laptop. Right now, if you wanted to, if you bought a little Ethereum, you could conceivably actually participate in proof of stake, which is pretty cool. On the other hand, this makes the Ethereum protocol a lot more complicated, and you have to have defenses against a lot more varieties of attacks. The paper claims that Ethereum is overall more robust, and that largely is because the protocol is also more complicated. But at the same time, the protocol had to become more complicated in order to deal with a new variety of attacks that proof of stake is subject to. So I would say that security is a tougher challenge in proof of stake as opposed to proof of work. Because for proof of work to be safe, you really just have the simple condition that the majority is good actors. So in their own list, yeah, okay, they actually said that in this part. They offer greater security.
Well, can you describe what proof of stake is? Like how, like,
Yeah,
proof of work is the consensus mechanism that I just explained.
Mm-hmm.
How's consensus achieved in proof of stake?
I tried to explain it. Sorry, I didn't do it very well. You bet your own Ethereum coins, and if you act badly, you lose what you bet. So in order to issue a new block, you make a bet on yourself that you're going to act honestly. And basically, there's a queue in order to control how often, I think you said it was like 5 minutes or something for Ethereum, how often a new block is allocated. So you get into queue with your stake or with your pool of people who you're making a stake with for the 32 Ethereum. And if your block ends up being validated because you didn't do anything bad, you get a reward, and otherwise you lose your stake. And there are stricter punishments. There's a continuous functional definition of how much of your stake you lose depending on what you did, which is one of the complexities of the protocol. So you get additional heavier punishment, you lose more stake as the chain that you committed to becomes longer and more invalid. So the harder you try to do a fork or do something nefarious, the more severe your punishment will be. So in the same way that proof of work aims to make it exponentially harder, the more isolated you are to make a nefarious fork. Proof of stake takes that even further and ramps up more quickly because there's a greater opportunity for groups of people to cooperate in order to, instead of relying on computational power, you have greater collective bargaining. I hope, is that kind of clear? Like You don't need a whole bunch of computers now to try to fork. You just need a whole bunch of people. And you could get a whole bunch of people to just agree, hey, let's do a scam and fork. So you need to specifically defend against these kinds of attacks now. So
let me ask you some questions. In proof of work, it is very clear who gets to create the block. That's the one that solves the cryptographic problem.
Yeah.
There's a whole bunch of miners that try to do that.
Yeah.
In proof of stake, how is the entity
there's a queue.
queue?
There is a decentralized distributed queue that I suppose is enforced with a consensus. And you get into a queue, and when you're next, that's it, you got your block.
Is it queued or random? But I think in the generic.
Might be random.
In the generic form of proof of stake, it's like a bidding mechanism. So basically, I can take some portion of my Ethereum holdings, and I can say, I'm willing to put this much of my Ethereum at risk for the right to author the next block.
Mhm.
And if I do the wrong thing, and I get caught, everything I put at stake.
Not quite everything. They
Well,
compute something pretty complicated.
Up to.
There's a range that you lose.
Gone, right? So for the whole thing.
Yeah, so
Uh,
conceivably you could actually lose some of your stake just because like bad luck, which does happen. But
And-
statistically, if you continuously contribute to the chain, you will earn.
Well,
That's
it's
positive.
the thing I'm earning, unlike this, there's no reward.
There's a reward.
No, it's only transaction fees,
Yeah, that's the reward.
which is,
Sorry.
so there's a built-in like creation of currency mechanism in Bitcoin.
Yeah, it
where
doesn't
the
issue
Ethereum is
new.
not-
Yeah.
It's not printing net new Ethereum,
Uh-huh.
instead it's saying, you know, you guys all had one transaction you wanted to commit, you all gave me 0.1 Ethereum. As your
Exactly,
transaction
yeah.
fee, and I get to keep that because I did the right thing.
Okay, let me ask you a couple of questions. So we have the miners in proof of work. How are they called in proof of stake?
Attestants or something?
Attestants? Okay.
It's a weird word. But
Attestants, so there's probably thousands of attestants.
the validator sends a vote. That's their attestation in favor of that block across the network.
Okay.
And I guess the validator is the one that actually makes the stake, and attesters are people who validate their stake.
So we have validators, and you're saying that they're randomly selected, like, hey, you're now the one that gets to create the block.
Yes.
Okay, and then, so I then create, like, I'm the validator, I have 32 ETH, I create the block.
Yeah.
Now what happens?
You tell everyone that you created the block, and people attest you.
Okay, so there's a set of other validators that basically say, hey, this block is valid or not.
Yes. And conceivably, like the thing that's a little confusing for me still is like this choosing of who makes the next block. I'm a bit fuzzy on that. Like, is there a situation where two people could make a block at the same time? Is that why you need these attesters to select one? Can you also get the same forking situation where one of the chains needs to get pruned? I didn't really get that from this paper or from the Ethereum paper. I don't
I
know.
think these are great questions, and I don't know. I encourage you to see whether you can find the answer, and maybe on Thursday you can share it. Because I think these are excellent questions, because obviously over here, we spend a lot of time talking about forks and what sort of issues that generates, right? Like, if that's not the case in proof of stake, great, simplifies things much more.
And I know it's like a delegated proof of stake, so it's usually people who have the most money invested are delegated you to be chosen to, you're gonna make the next block that you invest the most money into it.
It's a weighted random, so
Yeah.
if I put in 10 times more than you, it's 10 times more likely that I get the ability to create them.
Every individual stake has an equal chance.
They don't want the same person to get over it.
Mhm.
And I think also just like, I think multiple people can try to validate one, be like, you do it maliciously, then eventually you get beat up. Other people validate, will check your work, be like, hey, this guy also made something, it's kind of bullshit, and then they won't let you, they'll kick you out of the network and they.
It's the slashing that what I mentioned, right? Where you create a block, but it is not valid, and then the testers basically say, hey, it's not valid. And then you get slashed, or your percentage of the stake gets slashed.
So I think that for proof of stake, they, yeah, like Mark said, so basically, I think that the protocol will like infra-robbing or like some kind of like deterministic random functions, something like that. Choose like who will be the next to close block, and then if that block is not valid, then the protocol will like, choose another one. So I think that there won't be any of the situation where there are two valid blocks that happens. I think that. Yeah.
You don't think it can happen? Yeah, so here it says on depositing their Ethereum, the user joins an activation queue. So that's where I got the queue from. There seems to be some queue choosing what stake will create the next block.
I think the activation queue is more around like, hey, I want to be a validator. I put my 32 ETH in, and there's kind of like a waiting period before you become a validator. And then separately, there's this selection mechanism where it's like, hey, you are chosen to create the block. So kind of two different mechanisms.
Okay. All right. Yeah.
Right on. Well, thank you, Oleg. And I'm glad we're able to talk about that now in that,
we just covered proof of work and proof of, so very timely to also cover proof of stake. Now, one thing to keep in mind, whether something is proof of work or proof of stake, in terms of how you interact with the blockchain, makes no difference. Now, there are concerns around kind of the security of proof of stake versus proof of work, and we'll kind of have to see how that pans out. While there are a whole bunch of proof of stake chains out there, Cardano, Solana, Avalanche, etc., they're still fairly new. And they don't have a lot of TVL, which means total value locked, kind of like basically digital asset value on chain. Ethereum undoubtedly is the largest one. And so it's a big prize if you can hack that, right? So we'll kind of have to see how that turns out over the next few months and years, I suppose.
What's interesting is in proof of work, though, like proof of work incentivizes consolidation of compute power. Like over time, it's not plausible for me to go home and like buy a couple GPUs and be like, I guess better than everybody else on a 32 trillion, attempted, guesses. Like it might happen in the fullness of time you get one. But when you're competing against somebody who's got 1,000, miners sitting, next to the hydroelectric dam, to be able to run it. So I think what's interesting is like part of the concern with Bitcoin over time is like the rise of kind of like consortiums that have potentially damaging market, ownership, like to the point where
like 1,000 nodes on French node. Literally, I just make a bunch of nodes.
Well, I mean, let's say like there's 10,000 Bitcoin nodes today. Like I manage a fleet of 40,000 servers at work, so like it went through my head for a second. Like I'm like, wait a minute, like.
But it gets worse. You need an ASICs, specialized hardware.
Sure, I've got access to some of this.
Okay.
That's okay.
Well, some people are doing that apparently.
And I mean, what's interesting though is like, okay, 10,000 machines sounds like a lot, but if you're talking about 10,000 machines versus the total market cap of Bitcoin and being able to manipulate that market, that's a tantalizing trade-off. Now that's not lapsus teenagers, sitting in their apartment doing stuff, but there are state actors that would consider it.
There is a site, and my computer is kind of messing with me right now, but there is a site, 51% attack. Just search that, and basically it gives you information based on the total hashing power that is behind a particular chain, how much it will cost you to perform a 51% attack. So take a look at that. And there are certainly some chains like
There's all desktop.
that's
right. Not quite,
but I don't know what it is on Bitcoin. I would imagine it is terribly expensive. Now, the other thing that you have to remember that even if you perform a 51% attack, it does not allow you to do everything. You cannot create Bitcoin out of thin air. One thing that a 51% attack would allow you to do is double spend.
Rewrite history. Yeah, because you could intentionally create a fork in history. So you could pick a predecessor and build from there and eventually surpass the chain.
That's true. That's true. Yes, you're right. Because basically what a 51% attack allows you to do is create a chain that is longer than really the valid chain, temporarily.
$752,000 an hour.
How much?
$752,000 an hour.
That's assuming you can even have a market interest.
Logistics. Like, you have to get your money that it's some cost of living and it's like use.
Well, the other issue is that if you actually successfully do it and it's found out. I don't know that they can roll back. The protocol, I mean, the rest of the nodes would accept yours as the consensus chain.
If it's like a big enough,
Ethereum gets out.
Who's then?
whoever loses their money, they'll, if you steal a lot, they'll raise the they'll put pressure on the node operators.
Ethereum has split someone who lost a lot of money. They have like the whole Ethereum and then Ethereum 2 because someone upset and like let's just fury this and then people got mad about that. I think that's the thing. So you could kind of do that, but if you split, there's like less people like and this.
Well, yeah, like the way you solve that problem is literally like you create a major fork and now you have like Bitcoin compromised and Bitcoin not compromised and a bunch of people that are really upset about how that happened and why. And how do you prevent it from happening again? And the answer is that the protocol, if the protocol is ever breached in that way, then the protocol is breachable in that way. And it is very hard to change that without going to a new protocol. But once you go to a new protocol.
So I don't think Bitcoin was ever 51% attack, but there's some Bitcoin forks that have. But anyway, let's move on. What this website shows is the Ethereum blockchain live. And basically what you see every 15 seconds or so, there's a new block created. And then these yellow bubbles here are essentially transactions that were signed. Now you see basically that there is this large pool in the middle that are essentially transactions that are queued to be picked up by a miner as they solve, well, now it's a validator, proof of
as they win the stakes.
proof of stake, yeah. But basically mempool, that's called the mempool. And then basically as a block gets created, transactions are picked from the mempool. Now, one thing that you want to maybe pay attention to is when a new block gets created, there are already a whole bunch of transactions in there. So again, let me talk about proof of work. A miner controls what transactions go into the block. They can pick from here. They can also pick from somewhere else. And they will always pick the transactions that are most profitable for them in terms of transaction fees. They're economically incentivized to do so. I think the one is it's just a transaction, and then the other one is contract invocation, I think. Yeah, see, contract invocation. And then this one is just ETH being sent. And then the bubble size is, I think, the amount.
Like grabbing a big transaction.
Exactly. Exactly. That's how that works. But I think that visualization is kind of cool. Oops. Okay. Okay, cool. A proof of work, think of specialized hardware that runs hot to solve the cryptographic puzzle. That consumes a lot of energy, whereas proof of stake, hey, you're randomly chosen, the validator that provided 32 ETH, that runs on my laptop, right? And so the energy consumption is vastly different. And I saw a quote that the energy consumption of Ethereum dropped 99.5% when they made that switch. This is the chart of the total hash rate of the Bitcoin miners. I think it's Bitcoin, yep. And sorry, I cut off the dates. But what you notice here that it went down quite a bit. And that was China basically saying Bitcoin mining no longer allowed. And then all the miners had to pack up their mining rigs and move somewhere else. The Bitcoin network survived that ban. There was nothing that impacted Bitcoin during that time. There was a lot of news, but
The computational cost per block did go down. So
Yeah.
that actually, it really trends up, but it has had historical points where it's gone down at different points in time.
right, because again, it kind of adjusts, right, based on the total hash rate and kind of the difficulty. And so it was very resilient. And so I think that was actually a great test case. Like, what if a country bans Bitcoin? What does happen to Bitcoin? In China, there was a lot of mining operation in China, and well, it survived. And so that was really a great, and kind of probably unintended test case. Bitcoin creation. So we've so far talked about kind of the paper and the consensus mechanism, but Bitcoin paper 2008, and then in January, the actual open source software was released. And then on January 3rd, the first block was mined, and we talked about kind of the message that was contained in that block. Hal Finney, Wei Dai, and Nick Szabo, they were all early Bitcoin users. Remember, they were kind of in the digital payment space. The first transaction, commercial transaction with Bitcoin occurred in 2010, where this guy bought 2 Papa John's pizzas for 10,000 Bitcoin, which are now worth $93 million. So those were some expensive pizzas that he had, probably not gold plated. Then Nakamoto actually disappeared in 2010. We haven't heard from him since, and handed over control to Gavin Anderson. So nobody knows who he is. Still a mystery. Yeah, I mean,
It's a pseudonym for somebody who.
yes, definitely. It has not come out, and that probably is a good thing, right? Like, Ethereum has Vitalik Buterin, and everybody is kind of looking up to Vitalik for guidance. Bitcoin does not have that, and so again, it's decentralized. It's a community, right? There's not one leader, and I'm not saying Vitalik is kind of the leader of Ethereum. I think he's a thought leader, but obviously Ethereum is also kind of managed by the broader community. After 2010, Bitcoin began to see more market adoption. The first Bitcoin exchange starts in March 2010 at a price of 0.3 cents. No, 0.003 cents. $0.003. Yes. Then Bitcoin started to appear on Silk Road, which is kind of like a black marketplace for all sorts of illicit goods and activities. Bitcoin reaches $1. $1. There was kind of the first regulatory guidance issued by FinCEN. FBI shuts down Silk Road. Bitcoin starts to enter the mainstream media. And then we see the first massive bull run in November 2013, where the Bitcoin price peaks at over $1,000. 2014, something really unfortunate happened. Mt. Gox, the largest Bitcoin exchange in Canada, collapses and causes the price to drop. Mt. Gox is
They were a magic card trading site, and they got into Bitcoin as a side.
if you want to learn more about Mt. Gox, there's actually a Netflix documentary that is quite interesting on it. There was, I don't know the guy's name, but essentially the CEO, and it turns out he was a big scammer. And then, Bitcoin adoption continues to grow. And I don't know why the timeline stops here, but then in 2017, we had another bull run. Bitcoin went up to $19,000. Bear market, Bitcoin was maybe around 4,000. And then last year, you probably heard another bull market and Bitcoin almost reached 70,000. Now it's 20,000. So very extremely volatile. Now, yeah, right now, between 18 and 20, something like that. Now, one thing that I also want to point out is, blockchain also, a new industry is really born. So first of all, you have exchanges and wallets. And so there's centralized exchanges. Think of Mt. Gox, Coinbase, Kraken, Binance, etc. Then you have companies that are building wallets for end users. So MetaMask, Ledger, Zengo, Coinbase has a wallet, right? Large companies that build these. Trading volume, tremendous. I think market cap, I think it's still over $1 trillion, if I'm not mistaken. Then you have, of course, the mining operations with highly specialized hardware that is able to generate that SHA-256 natively on the hardware directly. Then you have altcoins and dApps that are being created that create all sorts of ecosystems, and we'll talk about that probably next week. And then also a lot of analytics firms. And analytics firms, there's kind of two classes. There is one for kind of more investigators that are trying to follow the money for, cybercrime investigations, on any anti-money laundering, things like that. And then kind of the second class of analytics firms are more for investors. And this is super interesting because, again, you have to think about that all the transactions are public. Compare that to the stock market where that data is not readily available. And so you can see, for instance, when a Bitcoin was last moved, right? And so then you can start to classify people into, hey, these are long-term holders, and these are short-term holders. You can also classify people into, oh, these are whales, meaning they have a ton of Bitcoin, or hey, these are retail investors that just have 0.001 Bitcoin, right? And so you can classify essentially an account into these populations, and then you can monitor on how they behave. Like right now, it's a bear market. What are the whales doing? Are they buying? Are they selling? Are they holding? Right? And so you can start kind of use that data to make your own investment decisions. And Glassnode is a company that does this. Very expensive, but there's some free charts. Also, look into Bitcoin has some interesting on-chain charts.
Compared to like more pricing. You say expensive, like a Bloomberg term loan like $20,000.
Oh yeah, no, nothing like that. Yeah, certainly. I think if you're a professional trader, right. Now, Bitcoin, as I mentioned, the block creation is happens every 10 minutes. Somebody said, right? 10 minutes. So it's fairly slow, and then also quite expensive. So it doesn't really lend itself for micropayments. So it's like if you want to go buy a coffee, at Starbucks, probably not going to happen with Bitcoin, because you would have to stand there essentially an hour before you have several block confirmations before they say, here, you can have your coffee, right? And so there's the Lightning Network that was introduced to facilitate essentially instant payments with no block confirmations that are scalable and low cost. And basically the way it works, there's kind of these deposits and these payment channels that are being set up. Bitcoin today, market cap of $700 billion, 20 million unique users, tremendous amount of hash rate. It is also now legal tender in El Salvador. I think it's the only country where it is legal tender.
In Miami.
In Miami.
Crypto City, USA.
You also start seeing institutional adoption. I think the biggest institutional investor in Bitcoin is MicroStrategy. By Michael Saylor, they have 130,000 Bitcoin. He's certainly a Bitcoin maximalist. Yes, Oleg.
Around, it's apparently dynamic, but there's around 2,000 transactions.
Okay, yeah, that makes sense. Like basically they get bundled into one block, right? And then a new block gets created every 10 minutes. Criticism of Bitcoin, we already touched on a few of these: energy consumption, price volatility, used by cyber criminals, and used by cyber criminals, again, very interesting, because if you remember, I talked about early days of Bitcoin. Bitcoin was used for a kind of anonymous payment on Silk Road, right? And so I think in early days, probably, yeah, it was used for a lot of illicit activity. But Chainalysis is a company that kind of analyzes data as well, and they published a report a few months ago, and they associate kind of illicit use to a really small percentage. Centralization is also a criticism related to kind of some of the miners, right? You have, if you look at the chart here, a handful of mining pools, right? It's certainly not the decentralized network that we initially envisioned. Yeah. And then last criticism is really there's only a few use cases, right? You can transfer Bitcoin. Yes, sir. I did not know that. The other thing I want to mention is I talked about, hey, if you create a block, you get 6.25 BTC, right? If that were the case, over time, there would be just more and more Bitcoin being mined, right? And it would essentially always be inflationary. The way this was solved in the Bitcoin protocol is through halving of rewards, mining rewards. So basically, when Bitcoin first was created, you got 50 Bitcoin when you mined a block. And then in 2013, that was halved. So now you've created a block, you only got 25. And then in 2016, 17, 12.5, and now 6.25, right? And so that happens every few years, 3 years, I think, 4 years, 3 to 4 years.
What happens to the economic incentive when that plays out, though? And who maintains the ledger when it's no longer economically viable to pay for the energy to find the next block? If you can't update the ledger is worth nothing.
Yeah, that's a very good question.
That's 256 to double it, 512.
You go to Bitcoin 512. You could, I guess, the first block could be.
I'm sorry, what are you guys saying?
The same ledger, zero cut, all the hatches, and then you go.
You would take the previous ledger and have that be the genesis block for a new chain, I guess, is the.
Oh, yeah, I don't think that will happen, because I mean there's obviously a tremendous, it's $700 billion right now. It was double that a few months ago, or almost triple that. So I think in terms of the economic incentives, you no longer get mining rewards, you only get transaction fees. And so then, I'm sorry, what did you say? Only get transaction fees. And so I think this will work out then essentially for large transactions that pay a lot of fees, but probably not small transactions. And of course, the Bitcoin price needs to be high. Otherwise, that's not going to work out, right? There is a kind of investment model that I just want to mention here that kind of touches on the halving cycle, which is called stock to flow model. And so basically it looks at kind of the color coding on the right here is the number of days since or to the halving cycle. Yeah, to the halving cycle. And then you kind of see what happens with the price. So after the halving cycle happens, price usually goes up. Didn't work out this year as much. I mean, it certainly went up, but people were kind of hoping it went up there. It didn't happen. So we'll see what happens. Now, one thing to keep in mind is the halving cycle going to be continue to be relevant because the amount of Bitcoin that you get is already kind of small. Bitcoiners are a specialized group of people that are very absolute. They believe that Bitcoin is the only digital assets that we will need for the future. It needs no smart contracts. It needs no functionality. It just needs payments, like store value. The question. And proof of work. They would never, ever move to proof of stake. And Vitalik Buterin wrote an article a few months ago in defense of Bitcoin maximalism. And this is kind of interesting because he's the creator of Ethereum, right? And obviously he believes Ethereum is what is needed with all the functionality, and we see how successful it is. But he basically made a case in the paper that, yeah, I think Bitcoin maximalism is good. And kind of he said, well, we're living in a dangerous world. People are trying to control what is happening, right? And we need a robust and defensible security stack, and that is what Bitcoin is. And it does what it's designed to do extremely well, being essentially a currency. And so take a look at that paper. I thought it was super interesting.
The argument there being like the simple primitive is easier to secure than the complex primitive.
Yes.
Part of it's like the book makes the case of like, since the book makes the case that our entire financial system is flawed, but part of it is that it's predicated on the idea that it's become so complicated that it can't be understood and therefore can't be protected, which tracks in a lot of computer science problems as well. Like the more complicated your system is, the more likely your off holes can't even find. So I guess that's his point, is that he's trying to say like, look, the simple thing might be the thing that we can actually best protect.
Yeah, and if you look at Ethereum today, I mean, there is a very complex financial products that are kind of interplaying with each other.
Yeah, to me, the Ethereum ecosystem is no different than our financial ecosystem as far as the complexity or the likelihood to get lost.
Yes, it's extremely complex. I mean, the only thing is decentralized, right? But I mean, even there, you could put an asterisk on some of that because some of the protocols are, and maintained by corporations. Yeah. So again, like Bitcoin does what it does very well, simple. And one more thing, then let's cut the last slide for today. This is also quite interesting in relation to Bitcoin. So there is the Security and Exchange Commission. Gary Gensler leads that currently, and he continuously makes the argument that cryptocurrencies are securities, meaning that they fall into purview of the regulations of the SEC. And in order to determine whether something is a security, there is something called the Howey test that has 4 criteria. An investment for money in a common enterprise with the expectation of profit to be derived from the efforts of others. That is the Howey test. And if these criteria are true, then you're a security. Now, Bitcoin undoubtedly is not a security, because if you think about how it was created, Bitcoins were mined. There was no, hey, like an ICO, like an initial coin offering that said, give me everybody $10,000 and I give you 100,000 Bitcoin in return. That's not how it worked. A lot of crypto projects work that way. And there is maybe, the question on whether they're securities.
Probably gets down to the definition of money as well. The investment of energy and resources in the manufacture of something is a through line to money. In the same way that like pursuit of happiness actually means property. So it'd be interesting. I mean, I like the direct line maybe isn't there, but the indirect line seems quite strong. Like,
yeah. But I think Gary Gensler, I don't think he has said that Bitcoin is not yet. Thanks. Not a security, although he is, very hawkish on regulating cryptocurrencies. But I think Bitcoin will most likely to be classified as a commodity, right? And all the other ones.
Well, and that may come down to the simplicity of Bitcoin then as well.
Yes, exactly. And so then if you kind of look at the statements of Vitalik Buterin, right, saying it's great to be simple and do this one thing really good and be pure, and because it is then essentially a different thing, and apparently it may get classified as a different thing by the government. All right, now let's have a break and then I'll come back here. No, sorry for going over. Great discussion. We'll just cover the content next time. If you look at the syllabus towards the end, there were a few lessons where I'm like, I'm not so sure what we're going to talk about. So we'll just, take our time. I really enjoy the discussions, and we'll just kind of push everything to the back. Please. Yes.
The global question, or it is like exchange for